Hi, Adam Khoo here, and I'm actually just back from vacation, so I'm just really excited to announce this latest course I'm going to launch soon called the Short Sellers Masterclass. And this course was actually put together because of overwhelming feedback and emails I've been getting from people to asking me, Adam, can you teach me how to protect my portfolio of good companies during a potential market crash? Or, how do I even profit during a bear market, during a market downturn? So I'm going to show you in this masterclass how, again, you protect your portfolio and profit during declining stock prices. Because if you have been watching the market recently and following my videos, you know that we've had a signal that the uptrend may be now reversing into a downtrend. We've had a signal of a potential bear market coming to play right now. So you got to learn how to protect yourself and to prepare for the market winter, I call it. A bear market or a major downtrend is signaled when the 50 moving average, which is the blue line, crosses below the 150 moving average green line and both lines start to flatten and slope down, or when the price of the S&P 500 breaks below the 200 moving average, which is the red line, and the 200-day moving average slopes down. Either one is a confirmation of a major downtrend, and we've seen that in the last couple of days, because you can see over here what has happened is the price has broken below this 200 moving average, the red line, and you can see it's begun to slope down. So that's a signal of a potential downtrend. Now, if I were to zoom out a bit, you can see that over the course of the bull market or the uptrend, every time the price has made a correction, it's bounced off the 200 moving average. Bounced off, it has bounced off, it has bounced off. So that has acted as a very strong support in that uptrend market. But over here, it has broken below that 200. And again, it's sloping down. So that's a sign that, hey, we could be in a bear market right now. Now, if you look at recent bear markets, let's take a look in the last 10 years, for example. Now, over here, you can see that this was a bear market, all right, where again, it broke below the 50, the 50 moving average crossed below the 150. It was sloping down. The 200 was broken, sloping down. So this was a bear market, and this lasted for 2 months. And this was a decline of about 15%. There we are, 15% decline for that short bull market, bear market over there. And going back, we had another decline over here of, again, about 2 months. And this short bear market went down about 20%, thereabouts, about 21% actually, to be exact, 21%. Now, of course, these are what we call baby bear markets. And every kind of like 8 to 10 years, you've got a major bear market during a financial crisis or dot-com crash. And again, if you look back in history over here, so this was the last major bear market where markets went down 55%. And this market was a major bear market that lasted for 1.5 years. And you can see that based on the moving averages, you could have seen the change in trend. Over here, you can see, if I just zoom in for you over here, again, the 50 crossing below the 150, the blue line crossing below the green line, both moving averages are sloping down, and the price breaking below the 200 moving average, the 200 sloping down, that is again a confirmation of a downtrend over here. And of course, if you zoom back even further, you'll have the previous crisis over here. And again, this was the dot-com crash. So this one, the market created about 51% over there. And again, you can see the signal is very, very clear with the moving averages crossing down. So the moving averages do not predict the future. They just tell you the current direction of the trend. So what we're seeing right now is we're seeing a potential of a bear market taking place right now. So again, how far is it going to go? So far, the market's down 11%. So if it's like a baby bear market, we'll be seeing another 10% down. If it's a major bear market, potentially another 40 to 50% down. So once again, if you want to survive a bear market, you have to understand a lot more about bear markets. So first thing, again, major bear markets come every 8 to 10 years. So it's been a 10-year bull market. If a bear market is coming right now, it's about time. I'm not surprised, okay? But bear markets don't last forever. Again, a bear market lasts an average of 6 months to 1.5 years. And during a bear market, stock prices will drop an average of 20% to 55%. Now, this is what separates the professionals from the amateurs, the boys from the men in the markets. Because, during a bull market, so for example, this is our current bull market, and it's been a bull market for the last 10 years. That's right, it's been a 10-year bull market. This was the previous bull market that lasted about 5 years, and this bull market lasted for, again, more than 10 years. And again, in a bull market, anyone can make money. Again, I like to say a blind, one-legged squirrel monkey could make money in the markets. That's why in a bull market, there are a lot of these gurus around. They say, I'm a guru, I can make money, because everyone can make money. See, in a bull market, prices, every time they fall a bit, they go higher. They fall a bit, they go higher. They fall a bit, they go higher. So anyone with a stupid strategy, with no money management, can make money, and they think they're geniuses. But when the bear market comes, like Warren Buffett says, when the tide goes out, you know who is swimming naked. So in a bear market, when stock markets start to decline massively, those people who do not know how to manage their portfolio, don't know how to manage their risk, and they don't have the flexibility of strategies, will end up losing everything they've made in a bull market. So that's not going to happen to you. So remember, here's the good news. Bear markets don't last forever. After every bear market will be followed by the next bull market. Now, if you're like a Warren Buffett and say, you know what, I'm just going to hold my stock and see it go down 50%, eventually you go up higher, yes, you can do that. That's not a problem. You can do that, right? But here's the point. In the meantime, during a bear market, during that 6 months to 1.5 years, as prices are going down, you can make profits from a bear market. You can choose to profit during a market decline if you have the right strategies, with the right mindset to short the market. And this masterclass is designed to show you exactly how to do that. So again, to prepare yourself mentally of what can happen in a bear market, let's take a look at past bear markets that have happened again in the last 20 years, right? So if we take a look, you can see that in the last 20 years, we have had these major bear markets. In 1987, if you watch this show, The Wolf of Wall Street, they talk about Black Monday, right? So this was when the market crashed 38%. This was a major bear market. We had the Asian financial crisis that was not so bad in the US, but there was a decline of about 19% over here. And then we had a dot-com crash, which was a decline of 51%. And most recently, 10 years ago, we had the subprime mortgage crisis, where markets declined by 55%. So again, currently we are here right now, and we are down 11% so far. So again, how much further down can we go? Could we go down 55%, 50%, 20%? No one knows how far it can go down. So, but it's important to know, again, when it happens, or if it happens, how do you protect your portfolio? How do you profit while markets go down? So again, that's the difference. The amateurs, during a bear market, all they can do is to watch their investments go down in value, sustain unrealized losses, and they can just suck their thumb. Now, of course, if you hold on to good companies, you don't have to worry, because eventually the prices will go back up and even higher. No worries about that. But here's the point. Professionals, besides knowing how to hold on to good companies, during a bear market, they also know how to profit by going short. So again, if you want to be able to make money consistently every single year, you have to learn how to short the market. And going short is a technique where you make money as prices go down. See, many people only know how to make money when prices go up. That's called going long, but you have to learn to go short as well. It's kind of like when Emperor Palpatine, right, or Darth Sidious told Anakin Skywalker in Star Wars. He said, to be a true Jedi, you must know both the dark side and the light side. Only then will a true Jedi will you be, right? Because it's kind of like in the markets, right? To be a true professional, you have to learn to short and to long the markets as well. So once again, why must you learn how to short the market? Number one is to hedge your portfolio of good long-term investments. Now again, if you have got a portfolio of good companies, in the long run, they will always go up. But in the short term, the markets are emotional. And you may see that the stock price of the good companies could go down 20, 30, or even 50%. So in the meantime, why don't you learn to make money as it's going down? Because eventually it will go high as well, but make money in the short term as well as the long term. Number two, when you learn how to go short, you're able to generate profits under all market conditions. So people say, Adam, how can I make money every single year? Now, if you can only make money when prices go up, you can't make money every year. You can only make money during, that's right, during bull markets, you can only make money. But during bear markets, you will definitely lose money. But if you can short the market, you can make money in bear markets as well. Okay? So you can see that in the last 20 years, bull markets have returned 107%, 104%, and 307% over here. But in bear markets, if you don't know how to short, you're down 51%, you're down 55%. But if you could short the markets, it means that this 51% decline would be a 51% profit. A 55% decline would be a 55% profit to you. All right, it can generate profits during recessions as well. All right. The next reason we must learn to short is so we can also profit from lousy companies as they collapse. Remember that not all companies are good. For every one good company, there are 10 lousy companies that are collapsing because of declining profits, scandals, recessions. So, if you learn how to make money as the price goes down, it increases your opportunity of profiting from companies as well. So again, if you look at Groupon, when it declined 73%, if you could short Groupon, that would translate to a 73% profit gain for you. Okay, now I always like to tell people, all right, think of all the times when you bought a stock in the past. Have you ever bought a stock and you saw that the price went down and you lost money? Now think about it. Think of all those times you lost money. Think of all the money you lost. Now, if you were short instead, that loss would have been a profit to you. All right, think about it, right? That minus 25% would have been plus 25%. And remember, during the last financial crisis, when many people said, hey, I'm losing money, the market is collapsing, guess what? There were people making billions of dollars as well. These are the short sellers. This guy called Michael Burry, who was featured in a show called The Big Short, he made $5 billion during the financial crisis by shorting the markets. John Paulson, another hedge fund manager, made $18 billion in profit as the market collapsed. So once you understand this concept, you know that there's no such thing as a good or bad market. A market going up is good if you buy. A market going down can also be good if you learn how to short. So I know some of you are asking, so how do I short the market? You talk about shorting, but how the heck do I do it, right? So there are altogether 4 ways you can profit from a market crash. 4 ways. Number 1 is to short sell the actual underlying stock itself. So you can short sell a stock or an ETF or short sell CFDs. And I'll talk more about that in a short while. That's the first method, okay? And it can be a bit risky if you don't know how to do it properly. So you have to learn how to place your stop losses. You have to learn how to exit and take your profits when it's the right time. That's number 1. Number 2, you can also profit from a market decline by buying inverse ETFs. Okay, there's a second method. The third method is to use what we call put options. Now, options are kind of like a contract. It's kind of like an insurance contract you buy from the market. So you can buy insurance on your investment portfolio. So when if your stocks crash, you can claim so-called the sum assured. You are assured of the profit that you get. Now, again, I'll talk more about that in a short while. And the fourth method is the safest method. It's the safest way to short the market, which is to use what we call vertical put spreads, which is to buy insurance in the market with reinsurance. Now, if you've got no idea what I'm talking about, let me do my best to explain to you step by step right now. All right, so the first method to go short on a stock or an index or ETF is to simply short sell the stock or ETF itself. So again, what does short selling mean? Short selling is a process where you sell an asset, whether it's a stock or an ETF, that you do not own at a high price in the expectation of buying it back at a lower price. See, many people in the markets, they understand the concept of, buy low and sell high. Buy high and sell high, make a profit, right? But when the price is going down, you do the opposite. You sell high and you buy back low and make the difference. So here's an example. So let's take a look at GE, General Electric. So this is a company that's been on a downtrend for more than a year. It's, suffering declining profits, losing market share. So it's an ideal stock that you want to short to make money as it collapses. Okay. So over here, you can see a clear downtrend signal where, again, the 50 moving average, the blue line crosses below the 150 moving average. and the price trades below the 200 moving average, the 200 sloping down, that's a confirmed downtrend. So that would be a good time to sell the stock, right? So at this point of time, it's selling at $27.50. So you would click the sell button and sell at $27.50. Now again, some of you will be asking, how do I sell something that I don't have? Well, that's why we call it short selling. So in short selling, you are selling a stock which you don't have. And how does that happen? Well, when you click sell, the broker, the stockbroker, will lend you the shares within a couple of seconds. It's an automatic process. So they'll lend you the shares, you borrow the shares from the broker, you sell it, and you get a credit of $27.50. We call this a credit, right? Credited into your account. Now, of course, you can't take this money and run because it's not your money yet, because you borrowed the shares to sell it. So you have to return the shares, right? So how do you return the shares? You've sold it. Well, the answer is by buying back the shares. So what you do is you wait for the price to hopefully go down, in this case going all the way down to $16, and you buy it back from the market. So when you buy it back, it's a debit, right? It's a debit minus, and it costs you $16 to buy it back. But you've already got this a $27.50 credit. So credit minus debit, which means you have $11.50 in profits. So you buy back at $16, you return the shares to the broker, and you made $11.50 in profit. So that's how it works. So people often ask me, so why would the broker lend you the shares to sell and return the shares? Well, because you pay a commission to the broker and you pay the broker a borrowing fee. Okay, and where does the broker get the shares from? Well, they get it from other investors who lend the shares to the broker. Now, you don't have to worry about the whole process. All you got to know is you can borrow the shares, sell it, buy it back at a cheaper price, and to return the shares. So that's how short selling works. Now, understand that short selling has its risk as well. And that's why when you do a short sell, you must always calculate how much you're willing to risk in your portfolio, and you have to always put a stop loss at a certain level, so that if the price goes up instead of going down, you have to quickly buy it back to cut your losses so you lose minimal. Remember that in trading, you can't win all the time. In fact, in short-term trading, you can only win 50 to 60% of the time. So the idea is when you lose very little because you cut your losses quickly, and when you're right, you make a lot more than when you lose. But you can't be right all the time. So always place a stop loss when you are short selling. Okay? Now, there are times when a stock could suddenly gap up in price. And if that happens, you could lose even more than what you intended to lose. So in the masterclass, I'll be teaching you that you should only short certain stocks that are safe. Avoid shorting stocks that are pharmaceutical companies, biotechnology companies, and penny stocks or low market cap stocks. These are really dangerous to short. In fact, the safest thing to do is to short an index ETF, like shorting the S&P 500 or the Dow Jones ETF. That is safer because when you short a basket of companies, it is unlikely to gap up. All right, it's very rare for it to gap up. It will often gap up a bit, but you'll go down back again. So that's the first method you can use to short sell stocks or ETFs. And we'll go through that into detail into the short sellers masterclass. I'll show you how to look for companies that are declining, that are not doing well, and how do we short these companies. Okay. Now the second method is by buying inverse ETFs. ETFs are basically exchange traded funds. Now usually you buy an ETF to track an index. All right. So for example, if you believe the Dow Jones is going to go up in the long run, which I do believe, you buy the Dow Jones ETF. So the ETF goes up as the Dow Jones goes up, right? But during a bear market, when you expect the Dow Jones to go down in the short term, how do you make money? You buy the inverse Dow Jones ETF. And it's called the DOG, the dog, right? They've got all these cute names, okay? So for example, during the last financial crisis, over here, you can see the Dow Jones went down, again, 55%. Over the course of 1.5 years. So as it was going down, you could have bought the inverse ETF, which is over here. So the inverse ETF is known as the DOG, D-O-G, right? Woof, woof, dog. This is the short Dow Jones ETF. So you can see that as the Dow Jones goes down, this ETF goes up. All right, so if you bought it at, for example, $52 and the Dow collapsed, it went all the way up to $90, you made a nice profit. Okay, now the beautiful thing about the financial markets is that for every index or asset, there's an inverse ETF you can buy to profit as it goes down. Okay, so for example, here are a couple of examples over here, right? You can, buy the short S&P 500, the short Dow Jones ETF, the short triple Qs. The triple Qs are basically the NASDAQ ETF, which are the technology companies, right? So same thing, right? If you think that bonds are going down, you can buy the inverse bond ETF. If you think gold's going down, you can buy the inverse gold ETF. So again, when's the exact time you buy it and when do you exit the trade? When do you place your stop losses? How do you identify the optimal time to go in? So all this will be covered in the Short Sellers Masterclass that you need to go through if you want to be a very, very effective short seller. Now, the third method and the fourth method to short the market is a bit more advanced, but it's actually the safest method, and it's to use what we call put options. Now, you may have heard of the word options before. What are options really? Well, put options, if you think about it, is kind of like buying an insurance policy on the shares that you own. Okay, now all of us buy insurance on our important assets. We buy insurance on our house, fire insurance, all right, mortgage insurance, and we buy insurances on our cars. So for example, if you buy insurance for your house for $1 million, that $1 million is so-called the sum assured, right? So if your house burns down, God forbid, the insurance company will pay you $1 million. Okay, that's the sum assured. Make sense? Same thing. You buy car insurance for $200,000 that basically insures the value of your car. So if your car gets stolen, it crashes, it's destroyed, the insurance company will pay you $200,000. But do you know that we can buy insurance on the stocks that we own? That's right. It's called put options. So first, a bit of terminology. Okay, so if you buy $1 million insurance on your house, okay, in the stock market terminology, we call this the strike price. The strike price, S-T-R-I-K-E, strike price. All right, just remember that word. Next, when you buy an insurance policy, there's a certain expiry date. So most of the time when you buy car insurance or house insurance, it's a 1-year expiry, right? They have to renew the policy. Now, same thing when you buy insurance on the stock portfolio, it's an expiry date. And it's up to you. You could buy a 1-month insurance, 6 months, 1 year, 2 years, or even 10-day insurance policy. That's right. So in the market, it's very flexible. We call that your option expiry date, right? Your expiry date. Now, of course, the longer the expiry date, the more expensive it would cost to buy the insurance, right? Now, when you buy insurance, you have to pay a premium to the insurance company, right? So same thing in the stock market, we call that a premium as well. We call it the options premium or the price of the option. So here's an example. So let's imagine that you own Apple shares. Okay, it's a good company. You think it will always go up in the long run, but you think in the short term it could go down because of the bear market, right? So, all right, Apple's up there, and say currently it's gone down a bit to $215. Okay, so Apple is selling at $250 per share, and you are afraid it may drop to $100 during the bear market. So you want to insure your shares for $215. So what you can do is you can buy an Apple put option with a strike price of say $215 or example $212. So what does a strike price of $212 mean? It means when you buy a put option, it means you now have the right to sell Apple shares at $212 no matter where it goes. So even if Apple goes to zero, you will get paid $212 for your Apple shares because you bought insurance. It's called a put option, right? Now, if you buy a put option at a strike price of $215, that means that you have the right to sell Apple shares at $215 no matter where the market goes. Again, the market can go to zero, the Apple stock can go bankrupt, you will get paid $215. Okay, now again, nothing is free in life, right? If you want to insure it for $215, you have to pay an option premium. All right, there's a certain price to pay, And in the short sellers course, I'll share with you, how do you calculate the ideal premium to pay, the expiry date, the length of the contract to protect your stocks. Okay, so again, a put option gives you the right to sell Apple shares at a certain price. We call that the strike price. And if you take a look at any broker, I'm using Thinkorswim to analyze my put options. You can take a look. These are put options on Apple. So for example, if you want to insure Apple at 215, that's the strike price, it costs about $13. All right, $13 to insure the shares. Now again, this is in a contract of 100 shares. Now if you think that's too expensive, you can always insure it for a lower price. You can say, okay, I want to insure Apple shares for $200. That's my strike price, as you can see. So this means that if you buy this contract, you have the right to sell Apple shares at $200 no matter what. Right? You've insured your stock for $200 and you pay, in this case, $6.90 to insure your $200 stock. So that's not too bad. It's kind of like buying insurance, right? So again, you'll learn all these concepts in the Short Sellers Masterclass. We'll be launching Right, so I'll be launching this Short Sellers Masterclass somewhere in the first quarter of 2019. So if you want to get on our waiting list and to be the first to be informed once the class is available and to get, of course, a very special discount to be one of our first students, do send an email to support@piranhaprofits.com and do check out our website at piranhaprofits.com for more details on our other courses. So let me just talk a bit about what we're going to cover in this masterclass. So they're altogether going to be 6 lessons, 6 power pack lessons on video. Again, unlimited access for the rest of your life until one of us dies first. It's okay, even if I die, you can still watch the videos because it's going to be on air, right? So lesson 1, you'll be learning all about how to go short. So if you know nothing about how to short, you're a total beginner, lesson 1 will bring you up to speed. You're going to learn how to go short, how to profit from declining prices, why successful investors must learn how to short the market, how do you identify high probability short trades, and how do you size your position? How many shares do you short? How do you manage your risk? So if you're wrong, you lose very little, okay? Lesson number 2, how to short sell stocks, ETFs, and CFDs, right? So I'll go through you step by step. How do you short a stock or an ETF? How do you trade certain short setups? We call it the rally on the downtrend, the breakdown from consolidation, and reversal into a downtrend. Okay, so a quick lesson for you over here. Remember that in a downtrend, stock prices don't go down in a straight line. Nothing goes down in a straight line. It goes down again in a wave pattern. So it goes down somewhere like that, right? You go up, come down, go up, come down, go up, come down. And sometimes it may go sideways. We call that consolidation. Go sideways. And then it breaks and goes back lower again, right? So you have to know when is the optimal time to short the stock or to short the market. Now, you never want to short or sell at the low over here. Never do that, okay? Because if you short over here, there's a high chance it's gonna rebound back and hit your stop loss. So you always want to short during a temporary rally on the downtrend, right? So it rallies, you short over there and make a profit as it comes down. You got to take profit over here. It rallies again, you short before it comes down. If it goes in a consolidation, wait for it to break out of the consolidation before shorting. So you have to learn the precise optimal points to enter a short position and to exit a short position. Really, really important, right? So again, how do you enter and exit short trades? How do you place your entry price, your stop loss, and how do you take profits? Now, of course, you have to know the risk of short selling. Short selling theoretically has unlimited risk of loss. So you have to know how to protect yourself from that happening to you, okay? And how do you also use CFDs to short sell? And you can only use CFDs if you're outside the US markets, right? So in the US, you can use CFDs. So I'll talk a bit about that, but not too much, okay? Lesson 3, you'll be learning about how to use inverse exchange traded funds. So again, the different types of ETFs that are inverse to the indexes. How do you enter and exit these inverse ETFs? Again, how do you place your entry price, your stop loss? How do you take profits for those inverse ETFs? So that's lesson 3. Lesson 4, we go on to learning about put options. Again, remember those insurance policies I talked about? You'll be learning all about it. So again, if you know nothing about options, nothing about put options, I'll get you up to speed. You'll be learning about how to buy and sell put option contracts in the market. How do you calculate the intrinsic value of a put option, knowing when it's in the money, at the money, out the money. How do you calculate option premium? Learning the Greeks. Now, this may be Greek to you, but you have to learn things like delta, gamma, vega, theta, rho that tells you when it's a good time to buy and sell an option. Okay. How do you read an option chain? So again, all the basic stuff if you know nothing about options, right? Lesson 5, we go down to the strategy. How do you use the put option or the insurance contract to protect your portfolio? Okay. How do you go long a put option? The risk profile of a put option, the steps to enter and exit a long put option, principles to minimize risk and maximize profits, and the protective put strategy, how to hedge stocks with your put options. And we're going to look at a lot of case studies, and I'll show you live trading examples, how to key it into your broker's trading platform, how to analyze prices, and so on and so forth. So it's going to be really awesome. Okay. Lesson 6, you'll be learning the safest way, which is vertical put spreads. Basically, it's buying insurance with reinsurance. You can't get safer than that, okay? So the advantages of using put spreads. A put spread is when you buy an option and sell another option at the same expiry date to hedge your first option contract. It sounds a bit complicated, but once you learn, it's pretty simple, right? Again, what's the risk profile? How do you enter and exit a long put spread? How do you minimize risk, maximize profits? And again, case studies and live trade examples. So again, this is a special masterclass on short selling. So whether you are a long-term investor, you're a short-term trader, it pays to learn how to short the markets. Again, to be a true Jedi, you have to learn both the dark side and the light side of the market, so you can profit in any market situation. So once again, this is the Short Sellers Masterclass launching in the first quarter of 2019. If you want to get in on our waiting list to be the first to be informed once this course is available, do send an email to support@piranhaprofits.com, and do check out our website, piranhaprofits.com, for more details on our courses. This is Adam Khoo, and may the markets be with you on the long side and the short. Take care and enjoy the bear market while it lasts, and learn to profit from it.